Study Objective 3 starts talking about the concept of adjusting entries. Adjusting entries are necessary because over time, the revenue recognition principle and the matching principles won't be followed unless we make adjusting entries to keep things up to date. If we just go through a series of transactions for a certain period of time and we look at all of our account balances on trial balance, then we'll eventually see that our accounts are not up to date or not complete in terms of what's recorded there for lots of reasons. And here are some of the reasons for those accounts not being up to date. Some events aren't recorded daily because it's not efficient to do so. The use of supplies, for instance, you're not going to record a journal entry every time you go to the supply room and get a pen to use in your office. Some costs are not recorded during the period because the costs expire with the passage of time rather than as a result of a transaction. So there's no transaction that would prompt an entry. So if you've bought some insurance, some prepaid insurance, you've recorded it when you paid for it, but then as that insurance is used up, you would never record an expense unless you had an adjusting entry to offset or to reduce that asset and move some of that cost into an expense account. And then finally, some items may be unrecorded. So a utility service bill, for instance, that's not going to be received until the next accounting period. Well, the matching principle says you've got to record utilities expense as you use those utilities. Well, if you don't have a bill, then you have no basis for recording an expense. So what the matching principle says we have to do is record an adjusting entry to estimate or put some kind of an expense in that period that we use the utility. The types of adjusting entries are as follows. There are deferrals and there are accruals. I like to think of deferrals as cash first related adjusting entries. There's two kinds. Prepaid expenses, this is where we pay cash in advance for some asset that's going to be used in the future, like supplies or prepaid insurance. You pay in advance and then you get the benefit of those things over time. And then unearned revenues, those are also cash first issues, but that's when we collect money before we've actually earned the revenue. That's a liability when we collect the money, and then as time goes by, we earn the revenue, and we have to record adjusting entries to record the revenue and reduce the unearned revenue liability. Accrual adjusting entries are for when I like to call these cash second adjusting entries. This means that cash transactions have not taken place at the time when we have to record an adjusting entry. So accrued revenue adjusting entries would have to be recorded when we're doing work, earning money, but we haven't billed for it yet, and we haven't recorded any revenue yet. Accrued expenses would be like the utility example, when we're incurring costs because we're using up something we're going to have to pay for, but we don't have a bill for it yet. And then, after we make adjusting entries, we'll be able to take a trial balance, which was created from a bunch of transactions that we did. We journalized, we posted to accounts, and then we listed our accounts here. And we'll be able to update these balances with by recording adjusting entries to them.